We are at it again. We are trying to find some kind of equal footing in the stock market, and we are going back and forth with, our rates going up, rates going down. The 1 week, Chairman of the Federal Reserve, Jerome Powell, says we are getting dovish, more or less his meaning behind his remarks. And then we're not. We're going to stay, higher for longer in interest rates. And we just can't make up our minds as investors. Anyway, at least the collective market. I'm not saying you and I. We are live. You're watching. Be the boss of your money. I want you to be the boss. Be the boss of your money. Okay? Be the boss. All right. And this is what we need to. You need to wake the F up right now, okay? And pay attention to this because this is the big story. This is what's going on. We are, investors collectively are deciding, are we going into a recession, soft landing, or maybe not even a soft landing? Maybe the economy just is actually getting a little bit better now all of a sudden. We have seen economic statistics that have been out recently that are telling you, like the labor market, productivity numbers, some manufacturing numbers, things all of a sudden are pretty good. It's not what the stock market wants to. The stock market wants to hear things are getting worse so that the chairman of the Federal Reserve could say, we are, nearing the end of our interest rate hiking cycle, and we could be pausing for a while, leaving rates at this higher level for a while, but then we're going to start cutting. So we're just getting so many mixed messages. And it's like Lucy, you remember I did that live stream with Lucy and Charlie Brown? Every time Charlie Brown goes to kick the football, Lucy pulls it away, and Charlie Brown flies up in the air and lands on his back. And then the next day, Lucy says, I won't pull the ball away this time. So he finally believes her, and he goes to kick the ball, and she pulls the ball away at the last second, and he goes up in there and lands on his back. It's like over and over. This is the Lucy Charlie Brown market. So we were going down a couple days in a row. Um, it just what can I tell you? But it looks like we are back on track, and the market was down a little bit earlier today, was up a little bit today, down, and finally finished up on an important word. This is the most important word from the Federal Reserve since the word transitory. That's right. Think about that word. Transitory. Inflation is transitory. When supply chain issues clear up, inflation will moderate. And here we are with inflation. Yes, it is moderating as of late. After it surged, it's moderating. And now we have a new word, disinflation. What that means, what the chairman of the Federal Reserve means by that, because he told us this, it means he sees inflation rates coming down. This doesn't mean inflation rates, it doesn't mean prices go back to where they were before the pandemic. It just means that prices start to grow only at a lower rate, maybe at 3 or 4%. Then hopefully we get to 2%. That's what he means. Disinflation is a word that he used several times today in the Economics Club of Washington. Let's roll the intro. We're going to talk about this. This is like serious stuff. I hope you guys are excited, at least as excited as I am. I love to nerd out in this stuff. So let's roll the intro. Stick around. We've got a couple of things to talk about. And I want to talk about artificial intelligence because that's like the other huge, huge, huge story of the day that's going to be with us for a long time, by the way. Here we go. Hey everyone, welcome back. It's Mitch Goldberg. Yes, I know we are all excited that I'm here. Thank you. Okay. Thank you very much. Thank you. All right. Thank you so much for joining me today. We are going to have a good show. So let's see if we could just hear a little bit of what the chairman was talking about. Okay. Let's see if I could do this. Let me get rid of the social media icons. Let's see if we can pick some of this up. The FOMC is the Federal Open Markets Committee. That's the group from the Federal Reserve banks that meets every 6 weeks to discuss interest rates. The two permanent members are the three permanent members is the chairman, the vice chairman, and the president of the New York branch of the Federal Reserve. And everyone else, the other five, there's 8 people in this committee. They rotate amongst the other Federal Reserve banks like St. Louis, the one in Minnesota, Dallas, okay, etc. I would love to be in on this meeting. I would enjoy it thoroughly. Anyway, it's interesting stuff if you want to start learning a little bit more about how these meetings how these meetings go. Okay, so I would love to be in on that meeting. So essentially, David Rubenstein interviewed Chair Powell at the Economics Club of Washington D.C. It's an annual thing. Everybody is into this. The chairman is not just giving his remarks, he's actually asked very serious questions by very seriously intelligent financial people, and they don't pull back punches. They really ask him serious questions. And he said that goods inflation is coming down. It hasn't happened yet. Um, it hasn't happened yet in services, but we have to see what happens. He continued to say he's he's data dependent, and that means he's taking it along. It used to be that chairpersons of the Federal Reserve were they liked the mystery, especially Greenspan, Alan Greenspan. People acted like they knew something unique. They knew something none of us knew, and they would speak in a very cryptic language, and it would leave Wall Street interpreting all kinds of things, every word. And it's morphed with Ben Bernanke, who was more open about Fed policy, and he was the guy who got us through the Great Recession. And I continue to believe he did a great job. Look, I could, yeah. Some people say, "Well, no, he didn't. He did this." Who the hell knew what to do back then? We hadn't seen that situation before, and you had to do something, and you had to make things work. It's easy to knock someone looking back, but when you're in the thick of it, it's a different story. That's how I see it. And I think followed him was Yellen, and then Bernanke, and the idea is they're data dependent. So when you heard former Federal Reserve chairperson speak, I think they were all data dependent. Paul Volcker also, they were all data dependent, but they didn't want you to think that they were making stuff up as they went along, that they didn't really know what to do or what to say. They were waiting for the next piece of data to confirm their last thought or to send them in a new direction. And now they're openly saying we are data dependent, and we'll see how the economy unfolds. Congratulations, guys. He's saying we are not fortune tellers. We can't tell you that in the 11th month of the year, that's when you're going to see the economy do this, interest rates do that, and the stock market will do this, and the labor market will do that. It doesn't work like that. They use very blunt instruments, which is interest rates and quantitative easing, to manage the supply of money in the economy, liquidity in the economy, and interest rates, which impacts borrowing. And they have to see how inflation does. They have to see what recessions we have, if there's weakness in the labor market. And they do all of these things to finally get to a point where they say we're cutting rates or we're raising rates. There's no magic here. This is basically a room filled with economists, PhDs, MBAs, and they're deciding on what they see in the economy, what should happen next. That's what it is. While you're watching this, guys, whether if you're watching in the live or the replay, I would also appreciate if you give us a thumbs up, a heart, an applause, a wow, depending on which social media platform you're watching on. If you have any questions about what we're talking about, go right ahead and ask me in the comments. Type it in there, or just say hello, or just show us your favorite emoji. It's a pleasure to hear from you. It's the best part about doing this. So that's the deal today. And he said there's disinflation, meaning inflation is moderating. The rate of inflation is coming down, and it hasn't gone to services yet, which this is a services-based economy. So most of the economy is services-based, but it is happening in goods, and he's going to keep pushing the lever. Now, my reasoning for the strong labor market in the face of the most rapid rate increases we've ever seen before. Fed raised rates 8 points, but 4.75, like almost 5% in under a year. The labor market has shrunk. So it's still hard to find people. People are still switching jobs for better pay. And, there's a lot of security for people in the labor market. It's getting a little tougher. Like right now, from everything I'm seeing, is that it's harder to switch jobs for just a better salary. So now people are switching jobs for whatever reason. There's lots of reasons why, but that's what's going on with that. So that's one thing. The next thing I want to talk to you is just a quick update on what's going on with the markets. Okay, so we had an up day after the Dow being down about 250, was up a little over 250, so up 265 in the Dow, almost 1%, up 226 in the Nasdaq, up almost 2%, and in between up 1.3% is the S&P 500. Now, you can't invest directly into one of these indexes, by the way. You can't invest directly into an index, but you could invest in a security that tracks or mimics an index. I know what you're thinking. What's the difference? Like, an index fund is so cheap to invest in. It's the same thing. It's not quite the same thing. Your index funds mimic an index. So you're investing in something that's mimicking the index, copying the index, but it's not the actual index itself. There's a difference. I have to tell you that. Let's move on. Gold was up a little bit. It was over 1900. Now it's in the 1800s. But, we'll see. If the Fed is serious about inflation, I really don't see why gold I don't see why gold would continue to go up. There's a premium for gold, I think, now because of strife, because of the Ukraine war and potential conflict or friction. Let's call it friction with China, not conflict. Let's call it friction. Oil had a big up day, up over $3 a barrel, West Texas Intermediate. That's a pretty big jump in one day for energy and, basically economic strength. China's reopening. OPEC is not pumping more. And, Chevron, instead of, pumping more or updating their facilities, their refiners, they're doing a $75 billion stock buyback. And I think that's because for Chevron, if Chevron's doing a $75 billion buyback, it tells me that Chevron does not really see the value in pumping more oil. Chevron doesn't see such a bright future for oil. That's what the giant Chevron stock buyback is telling me, when Chevron's buying a little over 20% of its entire market capitalization in stock. Okay. So let's get back to this. By the way, Natalie, when you see this, I like that Chevron idea for the snippet, if you don't mind. Just want to throw that in there while you're watching it, all right? 10-year yield, 3.68. So yields have been going up in the 10-year. The 10-year is still considerably lower than the 1-year, the 2-year, the 6-month T-bill. And it tells you that investors still are not convinced that long-term inflation is here to stay. But we do expect the Fed to keep rates at high levels, like around 5%. Maybe they get to 5.5% for a longer period of time. Don't expect a rate cut until maybe 2024. That's what we're discovering now, and the market's trying to find equilibrium. It looks like the stock market is saying, you know what? We're just going to see past all of this, and in a year or two, we think we're going to be fine. And that's why the market is that's why it rallied today. VIX was off a little, under 19 again, but VIX has been bouncing around between 18 and 21 for a while now. Yields are up across the board. You are getting almost you're getting almost 5% on a 6-month T-bill. See that? So when the government borrows money, it issues bonds called treasury bonds. But treasury bonds that typically, treasury bonds that mature in a year or less, we call those T-bills. So the 6-month T-bill is almost 5%. The 1 year is 4.87%. The 2 years 4.6%. Yields are, seriously attractive for many investors. And why not get close to 5% every 6 months if the yield stays here, like at this level, and wait to see what happens with the stock market economy before I commit more money to something that could potentially be extremely volatile. So that means stocks have a higher hurdle to clear to attract new money. That's what that's telling you. Okay. So the next thing I want to talk to you about is the artificial intelligence. OpenAI is a company in San Francisco. Excuse me. OpenAI is a company in San Francisco. You've probably heard of it because it's been all over financial news for the last few weeks. Incidentally, in 2015, one of the investors in the company who helped found the company is Elon Musk. A lot of people probably don't know that. So the guy's in that too, right? And Microsoft has invested in the company 3 times. Most recently, about 2 weeks ago or a week ago, they just invested $10 billion into OpenAI to make a chatbot. And what this is called, let me just pull up my the right notes. Okay. What this is called is GPT. So chat GPT, generative pre-trained transformer. And what this basically does is it takes how we use the internet to a whole new level. So when you go into a search, whether if it's Bing or Google, you search for something, the Battle of Gettysburg, for example, and you'll get thousands of articles almost instantaneously. And then you have to start going through the articles, reading the articles, learning about it. Maybe you want to write a report or an essay about the Battle of Gettysburg during the Civil War. Okay, the most from to this day, it's the bloodiest battle ever in the history of the United States, right? And but now with Chat GPT, it won't just give you the queries and you have to read all the queries. It'll actually give you the text version, like the 1-page version of what you need to know. And you could say, I want this in the form of a college essay. And it'll give you a perfectly written, grammatically perfect college level essay of the Battle of Gettysburg. So, and then a college kid could take that and put his or her name on it and turn that in like it's their own work. And that is a big worry. That's why some schools, high schools, colleges are saying you are not allowed to use artificial intelligence at all to write this. And if I think you are writing it with it, I think if you are using artificial intelligence to create your work, to do your work, I will fail you immediately and you'll be out of the class. Okay. So that is one part of it. There are so many people logging into going on to this open AI to see their how it works. About 13 million people a day, that when you go on it now, you'll most likely get a message that says, sorry, we can't accept any more users because we are full. But as more users use our artificial intelligence, the more it'll develop, the better it'll become, the faster it'll become. Then eventually we'll let more people on it. So Microsoft is taking this artificial intelligence, they're installing it throughout their suite of products. So that's what it does. So it's just rapid, immediate information. But instead of you reading all the queries, this will actually create one query just for you. It's all you need to know. And it could also create audio, it could create songs. People right now are playing with it, using it to create images and really cool artwork, and it's fun. Now, some people might think this is not fun because they get scared and they think of the movie The Terminator or something. But we've been using artificial intelligence for a while. For example, when you call the phone company, your cell phone company, and you want to get the balance, it says for the balance, say, balance or whatever, and then they direct you to the balance. Those are all basic parts of artificial intelligence, but this puts artificial intelligence on steroids. Now, artificial intelligence does have some shortfalls. For example, in the example I gave you, learning about the Battle of Gettysburg, the artificial intelligence can't convey to you the emotions, the shock, the sheer terror that was going through the hearts and minds of soldiers who were dying that day. It can't do that. It is very good at putting together information and spitting it out in a well-worded way. So this could be help with, this could replace journalists, maybe legal briefs, anything that's just putting information out in a clear, concise way. But it doesn't give you thought, emotion. It's not investigative prose, for example. And it's kind of dumb. Like one example I saw is, you know, the artificial intelligence could tell you that the rooster will cock-a-doodle do when the sun rises. But it can't tell you if the sun rose because the rooster cock-a-doodle dooed, or if the rooster cock-a-doodle dooed because the sun rose. It can't decipher that. It can't really describe the weight of a 20-pound weight compared to the weight of this stylus, which is, I don't know, extremely light. So those things it can't do. So there are limitations, but it is incredible at collating like literally the entire internet and creating something for you immediately. And the speed at which it works is not something that, a human brain can obviously do. So, um, and it's very expensive to create the software and to keep it going. It takes up a massive amount of space on servers. OpenAI, the company, has been using, from what I understand, has been using Amazon's Amazon Web Services on their servers and their server farms. Okay, and it's a watershed moment because it puts the use of artificial intelligence into the hands of everyday people, of us. So this is no longer just under the purview of data scientists and government institutions and corporations. Now anybody could get their hands on artificial intelligence and start using it. And I wonder if this could be translated into how to cook something, into teaching a robot, like, tell the robot, robot, make this, and then the robot will make a dish that it's never made before because artificial intelligence will guide it in terms of the steps it has to do to cook something, the steps it has to take to cook something, how long, preheat, take out of the oven and do all that. And I think that's where the artificial intelligence, I think that's where maybe it could start to get scary to some people, whereas you could actually have robots doing things based on this. But ultimately, the promise of it is AI for the masses so that we could do something else. So, an example I saw is like if you use a calculator to figure things out, you'll save yourself a lot of time. So you could do other tasks and move quicker. Now the artificial intelligence will do all the calculating for you while you focus on deciding how you want to word your query into artificial intelligence, I guess. Something like that. So that is what this is all about. We are using artificial intelligence daily. Now, you are going to be bombarded by artificial intelligence stocks because everyone and their mother is now going to be pitching I'm not talking everybody, but a lot of people are going to be pitching artificial intelligence investments. And this is where it gets dicey. So if you recall, when pot stocks started to get hot, all of a sudden, out of the woodwork, there were new pot stocks coming out. And people are like, oh, I got this pot stock. This one's better. They're going to do this. They have this special this, and they have that special that. It happened with internet stocks in 2000. It happened with pot stocks. It happened with crypto-related stocks. Whatever hot trend comes around, all of a sudden, you, the end consumer of investment products and services, you are the one who gets bombarded with these sales pitches and all these companies, and they all sound great. They all do something special. Probably none of them are going to have any earnings or revenues. It's just pie in the sky stuff. And I want you to be very wary of this stuff because, look, these investments could go up early. You might find an artificial intelligence exchange traded fund. You might find some other investment product that's packaging them. So this way you have a diversified portfolio. So you should hit one big winner in it. By the way, diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. Yeah, baby. So
diversification is a strategy.
Yeah, okay. So what we want to do is be wary of that. The main companies that are spending the billions and billions of dollars on artificial intelligence are the exact companies that you would expect, the ones with the real money. Microsoft just dropped another $10 billion on OpenAI. All right. Alphabet, which is Google, is announced today that they are a big all hands on deck in this presentation about Bard, their name of their artificial intelligence chatbot, or GPT. And then you have Amazon. I mean, Amazon's been using artificial intelligence to direct you to what goodies you should buy on Amazon based on what other people viewed and based on your buying preferences. Netflix, of course, Netflix recommends movies based on your tastes. They recommend content based on your taste and other people's tastes. People who've watched these movies that you have watched also enjoy these particular movies. This is all artificial intelligence at work. These are not humans actually typing in what you should be watching. And then there's Meta, which is Facebook. Okay. So you've got Facebook, Amazon, Netflix, Google, and Apple, and a few others. And I want to throw in NVIDIA, which supposedly has the brain, the chipset that puts all this stuff together. So if you're going to look at companies that are investing in artificial intelligence, I just named them. I mean, this is nothing new. This is nothing strange. This is nothing out of the ordinary. These are not recommendations. I'm just telling you that be wary of the sales pitches. There's an article today on CNBC. Okay, let me get rid of this. Analysts love these AI stocks with big upside potential to play the chat GPT driven artificial intelligence craze. CrowdStrike is one I recognize the symbol. But let me just scroll down here. The Globex Robotics and Artificial Intelligence ETF, the ARC Autonomous Technology Robotics. I wonder if any of these companies even have any revenues or earnings to speak of. Okay. So I'm weary. And I've seen these, I've seen people get excited about a new sector. They get all jazzed up and they throw money at it. And like almost every stock disappears, goes away. You go into your nuclear winter and finally the winners emerge. But you're competing against the likes of Facebook and Amazon and Google, Netflix, Apple, Microsoft. And I think you'd have to expect those companies who already have a huge lead in artificial intelligence to dominate. So that's my story, and I'm sticking to it. Careful out there. The artificial intelligence is real. All the promise of artificial intelligence that we've heard, it's in our lives now, but it's happening rather slowly. We expect artificial intelligence to cure diseases and do so many great things. It's taking a lot longer than people expected for all these miracles to happen from artificial intelligence. I do believe it'll happen, and it'll take a while. And in the meantime, you're going to see a lot of stocks go up on complete total hype. And I don't like to buy stocks at hype. That's all I'm saying. You have yourselves a lovely rest of the evening. I will be back tomorrow, and I really appreciate you spending your time with me. Have a good night.